Being able to live off dividends is a goal that many people have when investing in stocks. Consistently generating cash flow from your investments through dividends is a great way to build wealth and accumulate more shares throughout dividend reinvesting. Most companies pay dividends on a quarterly basis, but there are a handful of companies that pay out their dividends monthly. Today we'll be looking at the monthly dividend payers that we think provide the best investment opportunities at the moment. But before that, I'd like to know what dividend stocks are currently your favorites. Let me know in the comments, and if you are new to this channel, we upload daily stock analysis and other dividend related stock videos, so be sure to subscribe if you don't want to miss any. The first monthly dividend company that we'll be looking at today is likely to be the most popular one. It is even such a big part of the company's recognition that they trademarked it as their brand face, being the monthly dividend company. Of course, we're talking about Realty Income. Realty Income is a triple net lease real estate investment trust that generates revenue by owning and leasing out a diverse portfolio of commercial properties such as retail stores, offices, and warehouses. In a triple net lease arrangement, tenants are responsible for not only the rent but also the property's operating expenses such as insurance and maintenance. This business model ensures a predictable and steady income stream for Realty Income, allowing it to distribute dividends to its shareholders. The company has over 1,300 clients that are located in various countries, including some properties in Italy, Spain, and the UK, and the majority of their portfolio being located in the USA. And 99% of their property is currently occupied, which is impressive. Realty Income offers a starting yield of 5.2%, and looking at the price action, Realty Income has seen a decline of almost 8% year to date, and over the past 5 years, the stock has experienced a gain of almost 7%. One of the key aspects of Realty Income is its sustainable dividend yield. The company's adjusted funds from operations payout ratio is sitting at 76%, ensuring that the dividends are well covered by the company's earnings. Additionally, Realty Income has shown a 3.7% average growth rate in the past 5 years. Realty Income has a strong track record of consistently increasing its dividends over time. The company has increased its dividends for 29 consecutive years, making them a dividend aristocrat. And since they pay monthly dividends, Realty Income hikes their dividend every quarter. To see if the stock is currently trading at an attractive price, we have performed a valuation. Out of our valuation, we get a fair value of $72.53, but of course we'll have to apply a margin of safety. In this case, the margin of safety of 25% that we have based on financial ratios and the financial health of Realty Income. Applying this margin of safety, we're left with a fair value of $58.03, which is very close to the current price of $58.62, indicating that this might be a great moment to start scaling into a position. Oh, and by the way, if you want to get your hands on this REIT valuation model, you can check my Patreon that will be linked in the description. But with that, let's go ahead and look at the next monthly dividend paying stock. Today's second company is Stag Industrial. Stag Industrial is a REIT that focuses on owning and operating industrial properties, such as warehouses and distribution centers. Its primary revenue comes from leasing these properties to various companies, often on a long-term basis. And of course, this business model allows investors to benefit from the income generated by the industrial properties without direct ownership or management responsibilities. The company has a significant presence in the USA, owning 558 properties across 41 states. With solid tenants such as Amazon and FedEx, Stag is looking great on that department as well. Stag kicks off with a starting dividend yield of 4.13%, and year to date the stock has seen a nice move up of over 10.5%, and over the past 5 years the stock has seen nice returns of just under 30%. A cornerstone of Stag Industrial's appeal is its sustainable dividend yield. The company's adjusted funds from operations ratio is sitting at just under 75%, ensuring sturdy coverage of dividends by earnings. But in terms of dividend growth rate, Stag hasn't been doing massive increases, with their growth rate in dividends over the past 5 years being an average of just 0.7%. The company has never performed dividend cuts though, and has increased dividends every few years since their IPO in 2012, and it started paying monthly dividends in 2013. Out of a valuation, we get a fair value of $36.86, and applying the determined margin of safety of 10%, we're left with a fair value of $33.51, which is around 6% lower than the current share price, meaning that it's slightly overvalued per our valuation at this point. And if you're wondering what site I'm using for all of this data shown in the videos, it's Seeking Alpha, and you can get your hands on 14 days free premium of Seeking Alpha if you just check the link in the description. And the next company that we'll be talking about today is the only company that is not a REIT in today's video. Main Street Capital is a business development company, or BDC, that primarily invests and provides capital to small and lower middle market companies. It generates revenue by offering a combination of debt and equity financing to some of these companies, often in exchange for ownership stakes or interest payments. Main Street Capital aims to support the growth and expansion of these businesses by providing financial resources and expertise. It typically focuses on industries such as manufacturing, healthcare, services, and distribution. And as a BDC, Main Street Capital aims to earn a return on its investment and distribute those returns to its shareholders in the form of dividends. The dividend yield of BDCs are usually very high, and Main is no exception to this. They offer a dividend yield of almost 7%, which for BDCs is actually on the lower side, but of course in return you get your dividends paid monthly. Main Street Capital has seen a nice surge in its share price this year, with their share price being up almost 12% year to date. But if we look over the past year, the price is actually down by over 7%. And if we look at the longer time frame, Main has seen very little increase in share price over the past 5 years, it only being up a bit over 6%, but keep in mind that this is excluding dividends. In terms of that dividend growth rate, they have been increasing their dividends slightly over the years. But this is nothing special, with a 5-year average growth rate of just 3.4%. They do special dividends though, which is a nice addition to their monthly dividends. If you look at the chart of the dividend payments, we can see that Main has been paying monthly dividends for a while now, and these payments have gone up slightly over the years with no cuts. Since we have not built a valuation spreadsheet for BDCs yet, we cannot perform a valuation on this company, but instead we'll be looking at some analyst forecasts in this one. Most of the Wall Street analysts are actually talking about holding this stock currently, which is in fact exactly what this type of company is for, with some analysts indicating towards Main being a great purchase. They also see an upside of around 8% left, with a price target of $43.83. And the last company we'll be looking at today is Agree Realty, stock ticker ADC. Agree Realty specializes in acquiring, developing, and managing retail properties throughout the United States. The company focuses on providing high-quality retail spaces to a diverse range of tenants. Their portfolio includes properties in various retail categories, catering to the needs of both national and regional retailers. So far this year, Agree is down by almost 10%, and over the long run, Agree has seen a price increase of just under 19%. It seems to be a recurring trend with REITs that they underperform the major indices, but keep in mind that we don't take dividends into account into this. And speaking of dividends, Agree offers a dividend yield of 4.6%, and as for the growth rate, this is not looking too shabby either. They're 5-year, and since they recently started paying monthly dividends, they increase their dividends every 6 months. If we look at the dividend history, we can see that in 2021, Agree started to pay dividends monthly, and before that, we have also seen pretty nice dividend increases all across the board. Agree puts much pride into the fact that they have a high amount of investment-grade tenants, and this is not something to sleep on. Their tenant portfolio consists of high-quality companies like Lowe's, Walmart, and Home Depot. With such solid tenants, you won't have to worry about your problems regarding that. Once again, we've performed a valuation for this company, and out of our valuation models, Agree got a fair value of $87.41. We've determined a margin of safety of 25% beforehand, and applying this margin of safety, we get a fair value of $69.93, which is almost 10% higher than the current share price. And that wraps it up for this video. If you want to watch my previous video I made about undervalued REITs, click here. And if you want to be notified whenever I upload, be sure to subscribe to the channel. Hope to see you on the next one, and thanks for watching.